Yeah, yeah. Don't touch anything at all. Just, just let the tech do what it's gonna do. All right, so we are live, back live on my YouTube channel. People should be trickling on in. We had about 10 or so. It was up to like 19 almost.
Yeah.
Yeah, I was paying attention to that. It was about 19 people. So hopefully they got the memo. We are now live on my YouTube channel. We were having some technical difficulties, technical issues, but now everything looks clean, looks better. Hopefully it stays that way. And I see that we have 9 people here so far, so I'm just kind of waiting for people to jump on in. And please comment below if you can clearly hear myself and Sebastian, as well as the picture, that it looks nice and clean. Just give me some thumbs ups, some comments before we dive into everything. I'm going to do a recap for those that were with us on Sebastian's channel, and those of you that are watching this video live right here and you weren't on Sebastian's channel. We were attempting to do a velocity banking and infinite banking case study using one of Sebastian's clients.
This is
And
crazy.
so we're going to revisit that by doing a little recap here. And I'm getting comments now coming in loud and clear, which is beautiful. Sebastian, I want to give you the floor to talk for a few minutes to do another recap on your client, what's going on, and the type of strategy that they're wanting to put in place. And we're going to sort of map this out on the whiteboard here. And we got comments coming in that we're good. Beautiful, beautiful.
Are you hearing me clear?
Yes, sir. Passing the mic to you. Let me know if you're able to speak and give
But
a
I look like I'm
refresher.
frozen.
Okay, so let's do this. I'm going to do the refresher, right? If that's all right. I'm going to do the...
Only my problem, folks. So please forgive me.
Yeah. Sebastian, I'm going to go ahead and do the
So
recap,
I'll go
okay?
ahead and I'll just.
Yeah.
Say again.
Let me go ahead and do it because I think the issue might be on your end. I'm gonna do the recap, okay? Yeah, so you're not being heard at the moment. So, folks, technical issues again. Unfortunately, I'm not able to get Sebastian. He's a little bit spotty at the moment, and I did just lose him. So we got 20 people or so in the house. I'm gonna go right into it because I know this is extremely valuable for a lot of you that are trying to put these combined strategies together, such as velocity banking and infinite banking. So we're gonna take it right to the whiteboard, and I'm gonna give you details based on what I have so far. So to give you full context, this is not one of my clients. This is Sebastian's client, the approved guy. He's working with this person right now. I'm going to keep their name anonymous and just show you the numbers and the facts of the situation. Me not knowing much about the person, I've only had one discussion with them so far, right? Only had one. And in that discussion was more of like a hey, hello type of thing, right? So here are the facts of the case, right? We got the client working with Sebastian in May of 2024, and they were looking at the Money Max account, they were looking at whole life insurance, infinite banking, velocity banking, the whole nine. They were looking at everything. Between July and August of last year, they acquired a first position home equity line of credit with a bank called University Bank, which happens to be the bank that I also have a first position home equity line of credit with. Okay. Now, in addition to them getting approved for that first position home equity line of credit, that then gives them the ability to do velocity banking on their personal finances. But in addition, they were also looking at life insurance, getting approved for that. So the person got approved for life insurance around December of 2024. A significant amount of life insurance they were approved for, which is really good. So it creates a lot of flexibility in terms of the amount of money that they can fund into a life insurance contract, right? Now, prior to me entering the scene, right, they were looking at max funding a life insurance policy at a pretty high amount, right, at a pretty significant amount. And over time, from last year, now we're in 2025 in February, that total amount has been reduced down to about $26,809 going into the policy in the first year. Okay, this policy is not in force yet. This is just the latest design that Sebastian is working on with his client. And the way he got to that number was totaling up the total amount of cash flow that this person has in a year, along with a tax refund of $2K, savings of $6,000, and extra income of around $8K, so totaling around $16,000. So $16,000 plus cash flow in a year got him to this number of $26,809 going in the first year as a lump sum, and then years 2 through 10 going down to about $20,000 a year, and then after year 10 going down to just the base premium, which is somewhere around $2,000, a little over $2,000. Okay, so that's what's been presented. Now, to give you some more facts of this case here, you got the four major numbers, right? 7,913.16 is what this person makes as a husband and wife, so total income together. What I did not include is this person's side income. They have a coaching business on the side that makes some additional money. So I'm actually going to leave that out of the equation on purpose to be more conservative with all my numbers. Total expenses currently are $6,920.15, and the total amount of debt that they have is $394,000 currently, which leaves us with a cash flow of $993. We've got a first position home equity line of credit, $288,000, with an intro rate for 1 year at 6.25%, which, if it's accurate that this person got their HELOC around July, August of last year, then chances are their 6.25 rate is going to be expiring in the next few months here, somewhere around July or August. So we're not too far out from that timeline. I want you to keep that in mind. It's very, very important. And I actually gave you the numbers here. What's most likely going to happen, right, is they've got this intro rate on their first position home equity line of credit, 6.25%. So their cost of money on what they owe is this number right here, this $1,344.96 is their cost of interest for owing $267,000 on this first position HELOC that has a max credit limit of 288, right? For those of you that are seasoned on my YouTube channel, you've been watching me for years, you already know problem number one. You already know it, and if you know what it is, comment in the chat if you know what the first problem that we see here. Now, next is the intro rate expiring. So if I go from a 6.25 and let's say I go to an 8.75% rate, this person's net cost of money to owe this amount, $267,000, will be $1,953, and that's just interest-only payments. So that's a $608 increase in cost of living in just the next 4 months, roughly 4 or 5 months, is what we could potentially see. So keep that in mind, right? Now, the initial strategy that was presented to me was leveraging capital plus cash flow in a year times 12, right? To fund a policy, max fund it, to borrow against it, to try to pay off some debts, okay? And the amount of cash flow that would be gained is less than what that rate increase would be, roughly, okay? So it creates a bit of an issue here. So what I'm going to present is a very conservative viewpoint that the client and Sebastian can go and strategize together on, and then hopefully I can bring Sebastian back in to add in his points of view based on what I present to you. Now, the other details I want to give to you is the breakdown of the person's debts. So as you can see, we owe the $267,000 that's already owed on the first position HELOC, was nearly maxed out. We have student loans, we have a personal loan, we have a car loan, we have 12 credit cards. Didn't have enough space on my board, so I summarized it. 12 credit cards, $72,000 owed on credit card debt, with a total monthly payment across 12 credit cards, $1,541.46, with an average cost of money 22%. Right? Average cost of interest on this $72,000 is costing this person 22%. Right? It's very, very high. So as you can see here, all of their interest rates are at a higher rate than their home equity line of credit. This person initially was interested in paying off debt and also funding a life insurance policy, right? And thank you for answering Jesus in the comments, right? What was the first problem that we see here? Is they've used more than 2/3 of their line of credit. So not knowing this person at all, when looking at my rules, how I process things, how I work with clients, I like to give them a basis, a template, a framework on which to work off of to determine whether I should proceed with this method, with this strategy to accomplish my objective, okay? There's a difference between methods and objectives, right? Your objective is the goal. You're trying to get out of debt. And the method is the way we go about doing it, right? I just watched a fantastic video by Garrett Gunderson on his YouTube channel. It's the latest video that just dropped about, I think he said something about 5 big mistakes that people make with debt, right? So I highly recommend watching that video. It gives such a really good, unique perspective on things. And so what I want to share with you is my framework on how I'm going to inject both velocity banking and infinite banking into this strategy. And really, I want to fix what I want to see here is a tweak, an improvement before taking on more risk, taking on more leverage. If this person is to proceed with starting a policy out the gate, funding $26,000 a year in the first year and then 20 grand the year following, they're going to run into a major problem, which is they're going to have to pull money from somewhere to make the strategy work rather than just having the proper numbers to make the strategy work long term. They're going to have to keep leveraging to leverage to leverage to leverage, and can put us in a position where we just eventually run out of money, right? And now we're late on things. So what I like to see, I like to personally see $1,500 or more cash flow per month conservatively before max funding a life insurance policy to practice, let's say, the infinite banking strategy or the multiple strategies within the world of max funding whole life insurance policies, right? That's what I like to see, one of my parameters. The other is I like to see the person be debt-free, or all their consumer debts are knocked out except for, say, student loans and a mortgage. We don't have that currently. And then lastly is I like to have a line of credit that has space, that has equity, right? So that if I am going to leverage to max fund a policy, I have the space to do so. And I'm not putting myself in a compromised financial position. For those of you that are in the comments, I want you to comment based on what you see here, based on this debt, based on this income, cash flow, right? Their cost of living. Would you say this person is in a compromised financial position? Yes or no? I want you to comment below if you think this person is in a compromised financial position. Now, granted, they do have some capital, right? 16K. This person has 2 whole life policies already that has been in force for over 40 years, right? But they're 2 very, very small policies where they're only costing the person around $60+ a year, right? So so $60 a year over a 40+ year time frame, they've got $5,193 in available cash value to borrow from, and $8,907 cash value to borrow from. Okay. So according to Golden Kid, he says yes, just based off the numbers alone. No emotion involved, not looking at the experience of this individual, what they've gone through, not looking at circumstances, just looking at numbers alone. We can agree this person's in a compromised position that can lead to failure if I don't make changes, right? That's what I see here, right? So for me personally, I would not start with a whole life insurance contract to accomplish my objective. I think this person could get much better results and put us in a more stable financial position, overall a stronger position, and then start the policy at a later point in time. But there is something that we could do right now to lock in the person's insurability. Now, Sebastian took the time and designed what's called a convertible term life insurance policy. This little note that I made right here is a $1 million death benefit that would cost the client only $2,850 a year on an annual basis. So to lock in the health rating that they've already been approved for whole life insurance, if we can just convert that to term instead and reroute all cash flow to the velocity banking strategy, I think that would be the better move. Because if this person had a $267,000 mortgage, I would not probably be looking at velocity banking, because they're at the very beginning of that mortgage. So my focus wouldn't be on that. It would be on these other smaller debts. But what happened is, in my opinion, this person put the cart in front of the horse, right? The cart being this first lien HELOC, I think it was a little bit premature, but I also understand that prior to acquiring the home equity line of credit, I do believe they were in a really good financial position, and then they had to incur about $30,000 to $40,000 of new debt. So because that happened, right, we have to understand, okay, I got this first lien HELOC, but I've acquired almost $40,000 of new debt in such a short period of time, right? And now I want to do life insurance, but that would just create more risk because you're going to fund a policy to basically borrow almost all of it out. And that would be another violation. In terms of my rules, I don't like to borrow more than 2/3 of any tool that I'm looking at. So my goal with this client, with Sebastian's client, would just be like, what would it look like if we just did velocity banking on the home equity line of credit first to stabilize this debt tool, right? It's nearly maxed out. I do not want to hit max out on my home because now my home is compromised, right? That's not good. I don't want that to happen. So I want to create as much space as I possibly can in that home equity line of credit until the intro rate period expires. So let's just say the intro rate expires around July or August. It's February right now. I want to simply redirect all cash flow, all capital, and park it in the home equity line of credit. That's the most efficient use of my dollars for right now without having to lose those dollars. You can make a strong argument, well, Denzel, why not just attack some of these other credit cards? Well, if I do that, and yes, I gain some cash flow, but now that money's gone. I'm not going to be able to recapture, I'm not going to be able to see that money for a while. And if more incidents comes up, more crisis, more circumstances come up, then it's just going to compromise the individual even more, right? So if I was in his situation, I would be driving all my income into this first lien HELOC, creating as much equity and space as possible. And I'm actually not concerned with trying to pay off debt as of right this second. I really want to stabilize the HELOC. That's my first thought process because I got a ticking time bomb here. Do you agree? The payment's at $1,344. It's going to jump to somewhere around $1,900. I know this because I already have a HELOC with this bank. And if he got the same type of HELOC I did with the margin rate that I have, he's going to jump over 2 points, right? From where he's right now, is going to jump at least 2+ percentage points, maybe more. Okay? So that's not going to be fun, right? So what I would do to create some relief, we've got 2 existing whole life policies here that have been funded for over 40 years, as I mentioned. This is the total amount of cash value, $8,900 and $5,100. 66% of that is $9,300. Okay? These are the debts that I would eliminate to provide some relief and some immediate cash flow gain without having to repay what I'm consolidating into this asset. All right. So 1, 2, 3, 4, 5, 6, 7 credit cards within this 72,000. Follow with me. Okay. So we got 12 credit cards here, $72,000 total of debt owed, 1,541 payments, 22% average cost. These are 7 credit cards that I would personally pay off with my existing whole life policies. The total number, if you add it all up, is going to be $9,745.79. I would be shifting 29%, 19, 21, 31%, 10%, 29%, 29%. I would be shifting it to 5.75 and 5.4% inside of a whole life insurance contract. I would get an immediate guaranteed cash flow gain of $314.51, which lowers my cost of living down from 69 to 6605. That's the first move I would make, in addition to rerouting all income to the first position home equity line of credit. And I'm going to do velocity banking on the tool itself. And I'm going to instantly increase cash flow each and every month because my monthly interest cost is going to go down. So I'm going to be creating cash flow each and every month, even though I'm not necessarily paying off debt yet. And all while maintaining equity, capital for unexpected expenses and emergencies. Now, in my numbers here, I did not even include the capital that's over here. $8,000, $6,000 in savings, $2,000 tax refund. I didn't even include it in my little velocity banking scenario here, okay? So I'm gonna delete this. I illustrated including keeping this payment, this interest-only payment of $1,344.96 is included in this 6920 number. So I showed what velocity banking would look like over the next 9 months if all they did was drive all this income in, expenses out 6605, which is going to be a lesser number each month. Keep that in mind. By month 9 from February, so March, April, May, June, July, August, September, October, November, right? So 9 months, November of 25. The balance on his home equity line of credit should be somewhere around 256. I'll have a loan on between the two policies totaling $9,745. I'm not going to pay back the loan. I'm going to leave that outstanding. Whatever interest accumulates is going to be way less than all these interest costs. This cash flow, 314, driving into the home equity line of credit, bringing that balance down to 256, okay? And then I would take some of this capital, pay $2,850 for $1 million convertible term policy, and then redirect any idle cash to the first lien. So let's say from the 16K, I'm going to take 3K off. So that leaves us with, say, 13,000. If they parked 13,000 into the first lien HELOC, where are we at now? By month 9, 256, 155, 54, minus 13,000. Okay, we're somewhere around 243,155 and 54 cents. Now, let's assume that the rate expired around August, right? So months before we get to November, the intro rate already expired. So let's look at around this number, 256. What does my cost of interest go to at that point? It only went down from the 1953 number. I'm at 1,867 with 80 cents. If I can get it down to here, 250, 243, 155, 54, 0.75%. I'm only at 1773. So look at that. I went from, let's do minus 1344.96 So that's a $428 increase to as high as maybe $500 increase by the time the intro rate expires. So the work that we did over here got eaten up, right? That 314 gets eaten up inside the HELOC, right? So now my cash flow now decreases because the number went from 1344 to now 1773. So I would say in that case, if we were looking at 6605.64, and I'll add the 428 number that I showed you. So chances are his cost of living in a few months is going to be somewhere around $7,033.64. Okay. Now, keep in mind, this person does have additional income, right? Which is around, I think, $8,000 or more a year. So if we divide that by 12, it's an extra maybe $600, maybe plus $600 or more in a year, which means what? That'll kind of wash that increase there only if they continue doing velocity banking on the home equity line of credit. My goal would be to get this HELOC below 66% owed as quickly as possible. So 288 minus, so times 66%, 190. That's the goal. HELOC balance 190K. That's what I would like to get it to as quickly as I possibly can. On the way of getting there, I'm perfectly fine with doing micro chunking to eliminate more of these debts here. What is micro chunking? That's taking small bites to eliminate your debt by consolidating it into the first lien HELOC in small bites, okay? So let's say we get to November and the balance is around 243. My cost of money is about $1,700 a month at this point. We've eliminated 7 credit cards off the board. Chances are we're going to continue tackling this credit card debt, right? And reroute this payment or these payments in chunks, like one credit card at a time. So we did 1, 2, 3, 4, 5, 6, 7, right? So we have 5 credit cards left over here. And what I'll do is I'll see if I can, without revealing the person's info, I'm gonna try and pull up the spreadsheet to give you a clear idea as to what we're working with. Give me just a second here. See if I can pull it up without revealing too much. Okay, this is perfect actually. Yeah. All right, so let me show you the breakdown of the debt that we're working with. You all should be able to see this nice and clearly. So, oh dang it, there we go, now it works. All right. I'm gonna use the cash flow index formula to tell me what debts to pay off after we did the first 7 that we eliminated, right? And I'll give you an idea. So again, at the top here, that's our first lien HELOC there that we have, right? And they put the payment in there, so it's already included in the 4 numbers. These are the credit card balances, right? So 1, 2, 3, the bottom 3 get eliminated with the cash value loans. So Best Buy, Care Credit, Kohl's, we should eliminate that. I chose PNC, I chose Chase, Chase again, and Amex. So those are the 7 cards that I would pay off with my 2 whole life policies that I shared with you earlier on the board. Those are the 7 debts that would get me $314 in cash flow per month. And I'm not obligated to make any payments back to those loans. Am I back, everyone? I think I'm back now. Let me get one more comment that you guys can hear me and that I'm back. I'll wait for that. Thank you, Mark. Appreciate you. Okay, so you didn't miss much. All I did was just explain to you the remaining amount of credit cards left that we had was the 5 cards that I was sharing on that spreadsheet there. Based on what I've shared so far, I want to get some feedback on if you think the prescription that I'm laying out here is healthy enough, or if you think I might be missing anything or anything I could have maybe incorporated here. The only other idea that comes to mind that relates to this person's personal finances, and I'll pull up that little screenshot that I had there of the person's debts. The only thing that I would probably do or probably not do is maybe a 0% offer, maybe on a credit card. But I would need to know a little bit more about this person to see if they can handle that and not like fall under this velocity banking illusion, like when you pay something off or move it that you somehow have extra money. A lot of us fall under that illusion and mess ourselves up big time. So you think you have money, you really don't. It's that you park that money over here at a very, very low cost, and you freed up equity and cash flow over here. So it feels like you have more money, but it's like, no, you need to use that freed up cash flow to pay that back, right? You need to secure your win when you make a move with velocity banking, okay? So just to recap one last time, for this kind of scenario, we're dealing with an over-leveraged position on our first lien HELOC. We want to start a life insurance policy. That's great, but we would be hurting ourselves long-term, I think, just according to the numbers, not emotionally, just the numbers. What the numbers reveal is that there's simply not enough capital to work with to fund a policy at $26,000 in the first year. You could absolutely do that. But then the amount of money that you would have to borrow out just to get maybe $300, maybe $400, maybe $500, maybe $600, maybe $700, right? Recaptured. Even if you did that, it gets eaten up by the first lien HELOC balance. Because if you're going to fund $26,000 into a life insurance policy first, then borrow out of there and try to pay off some of the debts that I've listed here, you're definitely not hitting this one, right? You're definitely not doing that. But the problem with that one is it's a ticking time bomb. It's not like a regular mortgage. the monthly minimum payment can go up, it can go down. So I don't know if that person took that into account when they were, kind of running their numbers or even sharing that with Sebastian, right? So again, whatever amount of work that they do in this short period of time, because we know that they got the HELOC somewhere around July, August. I know it's a 1-year intro rate of 6.25%. It's gonna expire around July, August. Their payment, I know, is gonna jump at least 2+ percentage points of, at least 2 points above prime, or a point and a half above prime at the very least is what it'll likely jump to. Because I have a home equity line of credit with this bank, my current rate right now is around this number, 8.75%. It's like 8.74 or 8.4 something, right? But it's over 8%. So primary goal, get the home equity line of credit down as quickly as possible. Any extra money, any extra income, park it in the first lien, gives you that space, gives you that gap. Use your whole life, 2 existing whole life policies, pay off these credit cards right here, get that cash flow. That's going to help you make up for what you're going to lose in a few months. It's going to create like a little wash effect. And then just continue doing velocity banking for, say, all the way up until the end of this year. Then incorporate micro chunking, okay? Meaning you pay off 1 credit card at a time, right? Starting here, then we'll go to these bigger debt balances. And basically over the next 2 years or less, I want to be able to move all of this into the first lien over time, while simultaneously maybe funding another life insurance policy on this person, right? If they get the convertible term, they're locking in that approval rating, because that's the good thing, is they did get approved for a lot of life insurance, right? So it shouldn't be hard for us to get the $1 million death benefit. It's only costing them $2,850 a year. That could be paid from capital, right? At least fronted for the next 2-3 years. And just keep doing velocity banking, okay? Are there any questions related to this case or not that I could help with, okay? And I'm gonna see if I can get Sebastian back in the house here. But I see one that says, for the remaining 5 credit cards, I would change the due date to 5 days in front of the due date of the HELOC. This hides utilization on the HELOC. Okay, well, the good part here, Jesus, with this case, this person does have really good credit. So I think that in addition to everything that we're doing here, we could probably incorporate a 0% card to just buy more time, free up more cash flow to drive into the home equity line of credit. But outside of that, so then, okay, then he says, so then I would send double the minimum payment of each remaining credit card from the HELOC. This meets the monthly minimum on the 5 credit card, beats interest without raising utilization on the HELOC too. Okay, I see what you're saying there, but I think that's if my credit is bad, maybe I consider doing something like that. But because this person's credit's like good, not an issue, and they're not going to be accumulating any more debt, they're not going to be, trying to acquire anything. So I think it's more efficient to park all the money in the home equity line of credit for now, because that's reliable equity in space. It's a replacement of a savings account for the time being, while still having, plenty of insurance protection. Okay. Let me see if there was other questions. Does the convertible term policy become a usable infinite whole life policy once it's converted? The answer is yes. It's just not as attractive as you just starting a whole life policy out the gate. The real value of a convertible term is you're locking in your health rating at that younger age, that maybe you weren't ready to start a whole life policy structured for infinite banking, high cash value, and all that stuff. And so you can like, all right, let me get this term so I at least have some kind of protection, death benefit, protect my family, that sort of thing. And then you're able to, 5 years, 7 years, 10 years later, convert. And let's just say in those 5, 7, 10 years, you develop something in your body, something that made you uninsurable, or the cost of insurance is just really high and it's going to take a lot of years for that whole life policy to really build up. A convertible term is really attractive. I'm actually experiencing it for the first time with a client right now, where they have a convertible term life insurance policy with Mass Mutual, and we were looking at dropping that term to see if it'd be more advantageous to get a whole life without converting, right? Just getting a whole life, right? Going through that process. Well, they went through the process and they got denied for insurance. We went with the same company, Mass Mutual. Mass Mutual denied them for a whole life policy. So we just went right back to the convertible term that she has. And now we're in the process of converting that into a whole life. She doesn't have to qualify for that death benefit, right? At this older age that the person is at compared to when they first got it, I think 10 years ago, right? And this is the last year that they can convert that term into a whole life. And so that's where it becomes super valuable. And in that case, she can then do infinite banking based on the amount of money we're looking at funding, which is around $10,000 to $12,000 a year. Granted, a good portion of that has to go to premium. That's like the conversion rules that different insurance companies have. But it's still extremely valuable on the death benefit side. Question earlier, is the HELOC calculated into the expenses? Yes, it was, right? Which is why I just simply showed the math of income in, expenses out, because I already overestimated it. Didn't notice the 12 credit cards from earlier. Yep, that's, because I had to like consolidate it. Okay. So Jay says, what if your cash flow is $1,500, but your second lien HELOC has consumer debt in it, as I consolidated all debt into the HELOC, right? So that's great. So that sounds like in Jay's position, we're doing velocity banking with a second lien HELOC. $1,500 is the person's cash flow now. They made a move to consolidate debt into the HELOC. Move was made. Now they need to secure the win. Bring the HELOC down, right? Like finish the job. What a lot of us do, what I see is we're doing velocity banking with a HELOC, first, second, or PLOC. You moved a bunch of debts from all over the place into this line of credit, and it freed up all this cash flow. It freed up some stress. You no longer have 15 payments to worry about. You have 7 at this point. But then you learn about life insurance, infinite banking. You're like, how do I combine these things together? Sometimes that happens a little bit too prematurely, and then you still have your leveraged move that you did here that needs to be completed before you incorporate this. So I like to tell clients, like, finish the move, secure the win, and then your next, say, chunk or your next move could be funding a life insurance policy at that point. Okay. Let me see if I'm seeing any other points come in. Sebastian, let me see if I can get you in here. Can you talk? Are you in position to talk here? Say a few words. You are mute. Um, okay, wait. Now go. Now go.
Hey, I'm here.
Okay, perfect, perfect. So I know it had you kind of bouncing in and out, and then my live stream stopped. So there's been a whole lot of technical issues this evening. But based on what you did here, I'm sure you probably got cut off a couple times. Is there anything that you would like to add that maybe I might have missed in this? I want to
Yeah.
give you that
No,
opportunity.
no, I think you covered it well. Um, just just like I like what we that we just covered, that we should go ahead and use the existing policies that he has, and instead of trying to 1035 exchange that, just use the cash value there, keeping it at 66%, to borrow to help pay off some of the credit card debt. That makes sense on that. Everything's very clear, makes sense. The only thing is, some of those cards he had there, I think two or three of them are 0% interest cards.
They are
Um,
okay. That's good.
yeah, but they're going to be expiring in the next couple months. So that's fine. Everything you said was, your order of payoff and everything made sense. So,
So I'm assuming the big credit card balances are on 0%. Is that right?
um, I'd have to go back and double check it. I think it was the ones that were highlighted yellow. I think those were the ones that we wanted to knock out. I mean, I have to look at it.
Okay.
Let me see here.
Yeah. So let's just say one of the cards that I selected to be paid off was on 0%. Then the
Yeah.
only tweak I would make there is probably skip over that, pay off something else that is charging interest to get that cash flow. Um, but that's going to be another sort of landmine that we have to navigate, which is okay, when this card expires and this card expires and this card expires, if we're not able to roll that over into another 0%, then our monthly minimum payments are going to increase on that as well.
Yeah.
So I just, for me, and I think it'd be great to get on a three-way call with him, just to try to get him on everybody on the same page here. And I think he should, like, he seemed like a really reasonable dude for the first interaction I have with him today. But if he's willing, like, I think there's a world where we can turn this ship around for the better. And I do think he has the ability to make more money, which would make the numbers look better overall. That it's velocity banking on the first lien HELOC, get that down. That intro rate period is going to expire. I want to beat that by creating as much cash flow so that when the required monthly interest jumps, because he's going to increase by 2 points or higher, that whatever I did to increase cash flow and lower the gap, that it won't go past. Like, it'll just like go right back, kind of like as if I didn't do anything, or
Yeah.
slightly better. And then just continue to keep, paying down the HELOC, and then just like one credit card at a time, one credit card at a time, shifting the balance of these higher interest rates into a lower interest rate home equity line of credit environment. Get the convertible term, and I would say, hey, in like 2-3 years, like, we can convert this thing into whole life.
Yeah.
Do you
Yeah.
do
And I
you
think he'll be okay with that.
do you want to speak to conversion rules if you have more knowledge on that? Like, for example, if I have $1 million convertible term, am I able to convert a portion of that $1 million over time, or does it have to be all at once? Do you know about that?
So that's going to be set by the insurance carrier,
Okay.
and it also depends. There's a rider that also determines if you can extend the length of the conversion. So each carrier, each policy is going to have a different rule in terms of when you can convert it, how much you can convert. But ultimately, whatever the amount is, what we're really doing is we're locking in that death benefit. So the bigger the death benefit, the better, because what that gives us the ability to um, more or less work with a mech limit according to the death benefit, so we can squeeze cash value into the policy. Ultimately, if you have $1 million death benefit, when you convert it later, we're probably not going to use $1 million on the MEC limit. We're probably going to bring that down to, let's say, 450, 500,000 on the MEC limit. Um, but it's hard to predict that until we
Okay.
have a particular case in play and we can have an insurance carrier tell us exactly what the rules are. And then that does vary, it does change as the policy seasons and matures. So the best thing I can say is that we're not going to lose it. We're going to salvage it. We're going to be able to use it.
Yeah.
The bigger the death benefit is, the bigger MEC limit we can create, and the more cash value we can set up for a future policy.
Okay. So there is
I'm
a
sure someone
world.
else that has a little more experience on that could
Yeah.
add to it, but that's based on
Gotcha.
my
Gotcha.
feedback.
So there is a world where you could convert all of that death benefit, but it's going to be based off of how much money the person has at that point to max fund a policy, if that makes sense. Okay. And there was a
Right.
quick question that just came in from Jesus says, what's a 1035 exchange? So that is referring to if you have an existing permanent life insurance policy, whether it be an IUL or a whole life, you can roll over that policy into a new life insurance policy. Now, from what I understand, 1035 exchanges are tend to be a bit frowned upon. Just from what I've heard, like other content creators, it's not typically the first thing that comes to mind to do. But where I think a 1035 exchange has a lot of value is if someone designed a policy that wasn't according to your needs, and you've already signed the contract, you're already out of the free look period, that doing a 1035 exchange, especially if you put a significant amount of money into there and you want to work with another agent, or you learn something new and you're like, oh, I didn't know that this is what I got, so now you have buyer's remorse, then that becomes very advantageous. Now, let's say you have a poorly designed policy, whether it be an IUL or a whole life, but I'll just stick to whole life for now because I understand whole life a little bit more. Let's say you have a whole life with like Gerber, or maybe like, I think I've seen companies like uh, like not a mutually held life insurance company that your average infinite banking content creator would use, like these top mutual owned insurance companies, but maybe it's maybe it is a mutual owned company, but it's just not as known. Or maybe you have a whole life policy with a stock owned life insurance company, not mutually held, and you come to learn about becoming your own banker and how you can, leverage cash value, and you try to do that in your whole life, but like there's some limitations. Maybe the rate is higher, or the dividend's lower, or it's just not as flexible. Then a 1035 exchange is really valuable because maybe you have a good amount of cash value built up in there, but you're not able to access as much. The dividends aren't growing as efficiently, but if you roll that over into a better company with a better agent, with a better design, that could be extremely valuable, right? Then again, at the same time, there are cases that I've had with clients that have poorly designed whole life policies, but they've had them for 20 years or 30 years. And I'll look at the internal rate of return, what they're getting, and they're earning like 4% or more on it. So I'm like, like there's so many times where I'm like, either we just do a reduced paid up, or just pay the minimum on that, keep it in force, and let's just start a new policy with new cash flow dollars, just like this case right here that we're working with. This person has 2 whole life policies, and I get, again, the annual premium is a little over $60 a year that he's been paying for 45 years, I think. His money, when you look at the cost basis, his money has 3x'd in the cash value. So even though it wasn't designed for max cash value, like it performed pretty well for someone that's only saving $120 a year into two whole life policies, right? These policies were established when the client was a baby, right, or really really young. So I'm like, yeah, I'm like, I don't want to give that up. The total death benefit's like $33,000. So the 1035 exchange, you lose that death benefit. You keep the cash value, but you lose the death benefit, right?
Yep.
Mike says, you guys rock. Thanks for putting this on, Sebastian. Schedule a call with you tomorrow. Look forward to it. Awesome, awesome. Uh, Jesus says it's almost like a 1031 in real estate where you pay no taxes on property you sell if you put the money towards a new property within 30 days. If I'm not mistaken, Sebastian, do you know if you have more time than 30 days to do a 1031 exchange? I think you,
1031
yeah, for
for real
real
estate.
estate. For real estate.
I'm I'm not sure about it.
Okay.
Not sure.
I
I do
I
want to. I just want to emphasize on the 1035 exchange, just because you explained it perfectly. But I know that people always ask, can you 1035 exchange a term policy? And the
oh,
answer is no,
right, right.
because there's no cash value in the term policy. So when you're doing a 1035 exchange, what you're moving over is that cash value, is what you're moving
Right.
over. So you're now moving over death benefit or premiums previously paid outside of what available cash value you have in that policy that can be moved into the new policy. So
Yeah,
just wanted to add that on
gotcha.
top.
Yeah. Do you know off the top of your head if the okay and Sandy Perez just said 180 days for a 1031 exchange. So yeah, with um with the 1035 exchange, do you know if there are like any known like a standard fee with doing that? I do believe there is some cost, but I have to verify that to reach out to like
Yeah, again, that would be, I think that would be unique per carrier,
yeah
and then based on I don't think it's like a set fee like that. It would just, and again, it would be per carrier. So I'd have to do a little research for each of the carriers we are potentially working with and see
yeah
what thing about it.
gotcha. Well, other than that, is there anything else you'd like to share regarding this case? Anything just or we pretty much covered everything.
You know what? I do have a question for you, and this is kind of from a different angle, um, from a student of yours, me being a student of Denzel Rodriguez, you being my mentor and coach, as a banking practitioner, but also as a velocity banking coach. As a coach, you know, when how do you address or deal with um, when you prepare somebody to apply and get approved for a home equity line of credit? You're handing them off to the other company now, the bank or lender who's going to provide that. Um, you have set expectations and rules, but then once it's all said and done, they come back with a maxed out HELOC. Not because that's what they told you to do, not because
Right.
they chose to do that, but that's because that's how that company kind of forced them to accept and take their product. Is there anything you can do or say, or how do you kind of prepare the client to get into that, move into that step, to kind of minimize or mitigate um, them kind of stepping out of bounds in terms of the
Yeah.
utilization and the strategy?
So I will do my very best to encourage that client to book a phone call with me before they close on the home equity line of credit. So once we get to the final terms and conditions, because you go through the pre-approval stage, then they get this approval. Basically, they're going through closing on a first lien or second lien HELOC, and sometimes a lot can happen in that process where the bank's website said this, but in order to get this, your DTI has to be here. So they're requiring the client to pay this off into their HELOC. And let's just say because of that, it causes their $50,000 HELOC or their $100,000 HELOC to be over leveraged above 2/3 owed. There's been numerous scenarios where I will approve that, or I'll say, okay, let's go ahead and continue forward with them. We're going to be over leveraged, but understand that we're not going to be doing any chunking once you get this HELOC, because the bank is doing it for you. The bank is telling you what to pay off. And
Right.
let's just say I didn't love the order that the bank is telling us which debts to pay off, but there's still a cash flow gain. And I'll do the math and I say, okay, if we can get it below 66% within 6 to 9 months, I'll run the math on that. That's my first parameter. If I'm going to be over leveraged because of the bank, because of what they're telling me to pay off, as long as I can bring the balance below 2/3 within 6 to 9 months, say a year tops, then I'm going to say, okay, let's go with it. You've already spent 3-4 months prepping to get this HELOC. And so to have to go to a whole new bank and a whole new application process might not be worth it. So let's just rock it out with this particular bank and let's press forward. That's like the best case scenario in that regard. But let's use your example of someone that gets, say, a first position HELOC, and it was let's say it was a refinance, because when you purchase a home with a first lien HELOC, you're already going to be maxed out. So that just the game is different with that if you're purchasing a property, because you already, it's just like buying a home with a first lien mortgage. You owe this big huge amount. But with a first lien HELOC, you've got a maxed out line of credit, and the goal is to start to bring it down, right? So that we already know you're going to be maxed out, and the goal is bring that down. But when you do a refinance on a primary mortgage to a first lien HELOC, let's say value your home is $500,000, you only owe $2,000, and you're going to get a $400,000 line of credit. You're going to owe $200,000 already. We know that, plus closing costs. And let's say you and the client, you say, okay, that's all we're doing, and we're just refinancing. But then the bank says, hey, you got to pay off this card, this card, this card, and just put it all into the first lien. What I usually at that point, especially if it's University Bank all in one with CMG Financial or First Savings Bank, I like to get involved on that call to say, hey, is there any way around this? Like, is it a DTI issue? Like, or is it you just encouraging the client to do that? Because sometimes the banks like want them to move everything all at once, and then they'll show the math that it'll get paid down within this time frame. I still don't love that, because I like to do it in bites. So I kind of reduce the risk there. I like to do it in bites. But if it's a matter of no, it's required in order for them to get approved, in that case, it's going to come down to a personal preference. There's times where I'll tell the client, I don't think we should go with a first lien HELOC. If they're requiring us to pay off all this debt, and that's going to cause the HELOC when you first get it to be way over leveraged, the cost of money is high, you're kind of just tight, I'll tell them don't do it. If they don't listen and they get it anyways, it's not the end of the world, but it does put them in a compromised potential financial position down the line that they're going to have to wrestle with. I've dealt with it before, where someone gets a first lien HELOC, they max it out, and they've got $70 in free cash flow, a month at this point, or $150. And I'm like, you you stripped me of my powers, right? As your coach, as your accountability partner, you took it upon yourself to take this action, even though you hired me to help you make decisions. You made that decision on your own, so therefore, in this relationship, you don't need me. So there's been one or two circumstances where I give the money back to the client, and I say I can't be your coach because you know more than I do about your financial situation, and you've made that clear based on your actions. Or what I'll do is I'll say, look, I'm gonna, like, especially if they sign up for me like on a monthly plan, be like, hey, I'm gonna cut off the monthly subscription that you're paying to me so that you can have as much cash flow as possible. But we're not gonna work together for a period of time. I'm gonna cut that off. And when you're ready to be a real partnership and have a real accountability partner, I'm gonna be here. I'm not going anywhere. That's one way I've handled it, where they'll just be like, no, Denzel, like, no, I know I clearly messed up. And I say, okay, like, I'm still gonna cut you off. Like, I'm pretty firm on, like, you need to now do this, and I want proof that you're gonna follow this plan that I'm gonna give you, right? I want you to do it. I'm here to support. And when I say cut off, like, I'm not like gonna stop answering their emails or not do phone calls with them, but I'm not going to continue the paid relationship. Like, that's what I'm cutting off, the payment making to me, or subscription or whatever, or if I have to refund some money, whatever it is, I'll just be like, look, I need you to fix that and then come back. So that's a long-winded answer there. That's one way of handling it. I'll tell them, just don't do it. Instead of the first lien HELOC, we know you have all this equity. Get a second lien HELOC instead, And is it going to take an extra 2 months or so? That's fine. We'll just keep doing Snowball or Cash Flow Index or Avalanche without trying to force this concept to work, right? So that's where I'm at. Anything else on that?
No, thank you.
Cool. So we'll go ahead and end it here, folks. If anybody wants to get a hold of Sebastian on the life insurance side of things, you want to design a policy, him and I have teamed up after working together for so many years on business credit, personal credit, velocity banking even, sharing business both ways. We've now partnered up together in the life insurance industry where we're building an insurance agency together, where he is providing training for insurance agents, and he's also helping my clients put policies in place. So he's supporting me with that as well. So if you want to get a hold of him, on my website, I've got his info under resources, or you can just email me directly. I'll have links below in the description to get a hold of him. The Approved Guy is his YouTube channel, where you can see a lot of his work that he does. We're very similar, very aligned with a lot of the work that we do on the velocity side, on the life insurance side, infinite banking, with credit. So it's been a real true honor working with you. This is our first time actually like trying to take a case study that you're working on and kind of bringing me on and actually like documenting it. So I think that was cool to do that despite all the technical difficulties. But outside of that, that is all for this evening. Is there anything else you'd like to close with, Sebastian, before we go? Or did I
No,
lose you?
just
All good?
thank you for taking the time. Thank everyone that participated on the feedback. Um, definitely was fun. Let's do it. And that's all, man. God bless everybody. Take good care.
Beautiful.
Have a great night.
Awesome, awesome. Well, thank you all. Have a good night. God bless. And we will be talking soon. The last thing I'll share is I'm doing a live watch party of my proposal to my now wife on February 11th, 8:30 p.m. Eastern Time. If you want to tune in for that, you'll get to see this little movie production that I put together of me proposing to my wife. And then a week after, or that same week, we're going to be getting married. So love you all. Appreciate everything that I'm able to do here. It is because of you all that follow this channel, that subscribe, that like, that watch, that share, that actually do business with me. You've put me in this position to be financially independent, financially free, a good steward, very blessed. And so I want to share with you that personal part of, how I'm deciding to live this life on this planet, be a good steward, be a loyal husband, a loyal follower of Christ, and a very good business owner. Okay, and I hope to continue to improve and get better and put the best people around me so that I can get better. People like Sebastian, people like Chris Kirkpatrick, Caleb, Garrett Gunderson, and many others that I have the privilege of being able to just call them and schedule time. Daniel Romberg, Steve Parisi, and a few others, Alex Albaran, right? These are some of the most important business partnerships that I've created over the years that's been able to help you all, right? So with that, we'll end there. God bless you and talk soon. Thank you.